our bank staff. On those 4 dates, we used that projection as a basis for the forecast that we publish in our monetary policy report that goes along with the announcement. On the other 4 dates, we base our decision largely on how the Canadian and global economies have evolved relative to the previous forecast. Yesterday's announcement was one of the latter group. Before making our decision, we looked closely at how the economic data have been unfolding since our announcement in July. So let's first take a look at our last forecast and review what has happened over the last 8 weeks. Our July forecast painted a mixed picture. The outlook for the global economy was clearly weakening. At the same time, Canada's economic rebound from a soft patch at the start of the year was stronger than we expected. Globally, the big issue in July was the ongoing trade war between the United States and China. Rising tariffs and the related uncertainty about global trade policy were taking more of a toll on both trade and business investment than we had previously thought, and this was causing commodity prices to fall. Meanwhile, we saw growth in the U.S. economy was slowing to a sustainable pace, as we had expected. Another global highlight was that many other central banks had either lowered their own policy rates to stimulate their economies or said they were prepared to do so if necessary. These moves, along with the deteriorating global outlook, led to lower bond yields and borrowing costs in many economies, including here in Canada. And we can see that in our mortgage rates that have come down. Looking at all these factors, we forecast in July that the global economy would be weaker, but there would not be a recession in the United States or globally. In contrast to the weakening global outlook, however, most indicators for the Canadian economy in July were positive. Growth had rebounded more strongly than we had earlier forecast, driven by factors that weren't likely to last. For example, a surge in oil production in Alberta. Still, a strong job market and rising wages were supporting growth in Canadian household consumption. This growth, along with the lower interest rates I just mentioned, led us to anticipate the housing market would stabilize this year. We anticipated it would finish working through the dampening effects of various local housing measures, primarily in the Greater Vancouver and Toronto areas, and the B20 mortgage stress test rules that were recently implemented. All told, we projected the economy would grow at a pace of 2.3% in the second quarter of this year, and that inflation would be close to our 2% target. Global trade tensions continued to cloud the outlook and represented the biggest risk to our forecast in July. So that's a quick review of how we saw things in July. Now let's look at how things have evolved since then. The first thing to note is that the main themes from July have not changed. We still see ongoing weakness in the global economy and resilience in the Canadian economy. However, a few key aspects of the storyline have changed. Internationally, the U.S.-China trade war has gotten worse. Escalating tariffs and uncertainty are reducing global trade and investment by more than we had forecast. The volume of global trade has now shrunk for a third straight quarter. Growth in major economies is slowing as manufacturing output and business investment weaken. Specifically, recent data point to weaker momentum than anticipated in both China and the euro area, with the risk of a recession rising in Germany. The U.S. economy continues to moderate but remains solid, supported by consumer and government spending. Financial markets have continued to react to this weaker outlook, and more central banks have taken measures to stimulate their economies. Bond yields are lower, and the yield curve is inverted in many countries. An inverted yield curve means that short-term interest rates are higher than long-term rates. This is the opposite of how the yield curve normally looks, because longer-term lending is usually considered to be riskier. Historically, an inverted yield curve has has been viewed as a sign of a future recession, especially in the United States. Today, with interest rates so low to begin with, an inverted yield curve is more likely a sign that investors foresee slower long-term growth. In contrast to the global economy, the Canadian economic data since July have surprised on the upside. Last week, we received the National Accounts Report for the second quarter. It showed that the economy grew at a pace of 3.7%, much stronger than we had forecast in July. As you recall, I just mentioned we were forecasting 2.3%, so it came in much stronger than we had anticipated. Among the highlights from the report was labor income, which grew by 7%. This reflected continuing growth in employment and hours worked, and a notable pickup in wages. That rise in income, along with the lower interest rates, as I mentioned earlier, helped support unexpected strength in housing. And you see some of that strength here in the Halifax area. In fact, most people renewing a 5-year fixed rate mortgage today are actually paying a lower interest rate than they did 5 years ago. Housing is once again contributing positively to growth, with resales and starts catching up to underlying demand. High levels of household debt remain the main risk to financial stability. But with tighter mortgage rules in place, the quality of the stock of household debt should continue to improve. However, consumption was surprisingly soft in the quarter, particularly given the increase in labor income. And the national accounts data suggests that some of the economy's strength will be temporary. Exports were very strong, but much of that strength came from a sharp bounce back in shipments of crude oil and transportation equipment. Imports were surprisingly weak, and companies are still carrying relatively high levels of inventories. Business investment contracted sharply after a strong first quarter, likely reflecting in part the impact of the escalating trade war. Nonetheless, the strong second quarter growth means that the economy was operating close to its productive capacity or potential, a concept I'll explain in a minute. And inflation has been very close to our 2% target. Now let me spend a few minutes on the relationship between inflation and economic growth. This issue has been in the news lately because inflation rates in the United States, the euro area, and Japan have stayed low, even though their economies have been strengthening, at least until recently. In particular, there has been much debate about the continued existence of what economists call the Phillips curve. This is the idea that there's a close link between economic growth and inflationary pressures. Because of the persistently low inflation experienced in several major countries, some observers have gone so far as to declare the Phillips curve dead. Here at home, though, our experience has been different. As the title of my speech says, inflation in Canada has been well behaved. Before looking at the evidence to support this claim, I'd like to explain why this relationship is an important part of the Bank of Canada's approach to conducting monetary policy. As I said at the beginning of the speech, the primary objective of the bank's monetary policy is to achieve low, stable, and predictable inflation. Like many other central banks that also practice inflation targeting, we adjust our policy interest rate to try to bring the overall demand and supply in the economy into balance, so that all of our productive resources are fully utilized. At this point, our labor force would be fully employed, and the economy overall would be using all of its productive capacity. This is what we mean when we say the economy is operating at its potential output. The concept of potential output is important because inflation should be close to our 2% target when the economy is operating at that level. When there is a difference between the economy's potential output and what is actually being produced, we say that there is an output gap. So if we project that strong growth is likely to push the economy above potential, causing a positive output gap and creating a positive output gap and causing inflation to rise above our target, we may raise interest rates to cool demand growth. And the reverse is true. If weak growth is set to pull the economy below its potential, thus creating a negative output gap. So by adjusting our policy interest rate, we influence demand for output and employment, aiming to close the output gap and achieve our inflation target of 2%. To be sure, other factors beyond the output gap can affect inflation, measured by the Consumer Price Index, or CPI. Exchange rate movements can affect inflation because they directly affect the price of imported goods and services consumed by households. And because Statistics Canada calculates CPI inflation using prices for a basket of goods and services that a typical family buys, swings in particular prices and specific prices like gasoline can actually have a large impact on CPI inflation. So to help us see the underlying trend of inflation, we rely on a number of measures of core inflation that filter out the impact of some of these shocks. As a result, these core measures are less volatile than CPI inflation and do a better job of capturing persistent underlying movements in inflation, which is really what we're interested in. In 2016, bank staff evaluated various core measures in detail, which led us to announce that we would pay particular attention to 3 of them. As you can see from the slide, the behavior of these 3 core inflation measures in recent years offers some compelling evidence for the relevance of the Phillips curve in Canada. So the blue area in the chart shows the range of our 3 measures of core inflation, and the black line represents our estimate of the output gap. So to illustrate this relationship, let's think back to 2014, 2015, when the price of oil plunged. Growth slowed, and the economy slipped below its potential output. So you can see that in beginning of end of 2014 into 2015, the black line went down, which indicated that we are operating below our potential output. The output gap, in some sense, was negative. And at the same time, core inflation, represented by the blue band there, was well below 2%. Now, at that time, we cut interest rates to help facilitate the economy's adjustment to the oil price shock. The output gap closed fairly rapidly in 2017. You can see that as the black line moves up. And by the second half of the year, core inflation moved back up toward our target, responding to the closing of the gap with a bit of a lag. Since then, our measures of core inflation have been hovering around the 2%. This is consistent with our estimate that the economy has been operating close to potential output throughout most of this period. Today, the bank is publishing an updated evaluation of our core inflation measures that show that they continue to perform well. They are less volatile than CPI inflation and strongly linked with the output gap with a slight lag. This evidence of a close correlation between underlying inflation and the output gap bolsters our confidence in our inflation projections and in our framework for conducting monetary policy. The latest data show that total inflation remained right at the 2% target in July. This was a bit stronger than we'd expected, mainly because of temporary factors, including higher prices for air travel, mobile phones, and some food items. Our core inflation measures were also around 2% in July, which is consistent with the idea that the economy's output gap is essentially closed. So with all that as background, let me conclude by talking about the bank's decision yesterday. My colleagues and I began our discussions by recognizing that the data indicate that the Canadian economy is operating close to potential. The unemployment rate is near historic lows, and inflation, our primary responsibility, is right on target. The economy has clearly gotten past its earlier soft patch earlier this year, and the labor market has been strong and housing markets have begun to rebound. Although household debt levels remain high, mortgage underwriting rules are helping to contain financial vulnerabilities. This solid starting point means that the economy has a welcome degree of resilience to possible negative economic developments. That said, we agreed that the data shows some areas of concern. Among these is the weakness in consumption. it's difficult to square the softness in consumption in the data with the strength in labor income. And of course, we are concerned about the drop in business investment, which is likely linked in part to the ongoing trade war and related uncertainty. So we continue to expect economic activity will slow in the second half of the year. Given Canada's reliance on international trade, we agreed that the trade war remains our primary concern and the biggest risk to our forecast. Trade policy uncertainty has been weighing on business and exports for a couple of years now. We've been incorporating some of that uncertainty related to NAFTA starting 2 or 3 years ago, and so that type of uncertainty has already been into our projection. And since then, we've incorporated more uncertainty related to the conflict between the U.S. and China. Now, things could certainly get worse internationally, which would deliver a complex shock to our economy, affecting both demand and supply and demand. In this uncertain environment, central banks have been conducting monetary policy appropriate to their own circumstances and outlooks. This has contributed to lower bond yields and reduced borrowing costs in Canada. The Bank of Canada will continue to conduct monetary policy appropriate to our own circumstances. We will continue to ground our decisions in our policy framework, setting interest rates to achieve our inflation target, mindful of the implications for financial vulnerabilities. Our current policy setting of 1.75%, which is 50 basis points below the U.S. policy rate, continues to support the economy. To sum up, as I said earlier, Canada's economy is operating close to potential and inflation is on target. However, escalating trade conflicts and related uncertainty are taking a toll on the global and Canadian economies. In this context, the current degree of monetary stimulus remains appropriate. As the bank works to update its projection in light of incoming data, Governing Council will pay particular attention to global developments and their impact on the outlook for Canadian growth and inflation. Now, for those watching on the webcast, let me briefly give the most important message in our other official language. L'économie du Canada tourne près de son potentiel et l'inflation est à cible. Cependant, l'escalade des conflits commerciaux et l'incertitude qui en découle pèsent sur les économies mondiales et canadiennes. Dans ce contexte, le degré de détente monétaire en place demeure approprié. Pendant que la Banque s'emploie à mettre à jour sa projection à la lumière des nouvelles données, le Conseil de direction portera une attention particulière à l'évolution de la situation mondiale et à son incidence sur les perspectives de croissance et d'inflation au Canada. Ladies and gentlemen, I hope I've been able to shed some light on the bank's rate-setting process, and I thank you very much for your attention and look forward to answering your questions. Thank you again.
Feel so much taller up here. This is great. So thank you very much, Dr. Schembri. That was great. Thank you. If there are questions, if you'd like to just raise your hand, we'll be around to pick up those questions. In the meantime, I have a few questions that we prepared in advance. I was intrigued to hear you say that the inverted yield curve does not seem to be quite the disaster that I've been reading about in the newspapers. And I was intrigued by your answer, or your comment, I guess, which was in a time of lower interest rates. I guess it's harder to kind of have that curve, or easier for that curve to get to the inverted spot. So maybe you could comment on that.
Sure. A good question. I mean, what we've seen recently, historically, when the inverted yield curve has been seen as a reliable indicator of future recession, what's happened is that it becomes inverted because short-term interest rates are rising relative to long-term rates. Now, what's happened more recently is long-term rates are actually what's coming down to short-term rates. So the source of the inversion is actually different this time around as opposed to the past. And so this is a different situation, and we believe that it's a less of a reliable indicator of a future recession.
Okay. Again, questions if you have any. How much do external events, so you mentioned that Germany, there are, I don't want to put words in your mouth, so I'm being careful. But
okay.
You mentioned that Germany may be, there are people talking about Germany entering a recession, and other world events. So you said that the bank will continue to look at Canada's growth, Canada's economic climate. But I guess I'm wondering how much the rest of the world can start to impact us, and when do you know that it's time to change monetary policy in Canada based on the rest of the world?
Right. Well, as I mentioned, when we do our projections every 4 times a year, we look at both the global economies and the Canadian economies. And the things that are most important within the global economy for the Canadian outlook are really what happens in the United States. And I think one of the things we looked at for this decision is the fact that the U.S. economy looks fairly solid. I mean, it's still consumption growth is strong there. We expect more government spending. So we don't see a recession in July. We did not see a recession in the U.S. So we see the U.S. economy being relatively solid. The other thing that's quite important for us is commodity prices. And commodity prices have come down since April. And so that's, I think, a consequence of the trade conflict, and that's something we're paying close attention to. So those global factors do play a role in our projection for the Canadian economy as well.
Okay. Should I renew my mortgage now, or should I wait a month? Oh, sorry, I guess. Might be a little too close, I guess.
Yeah, that's true.
Okay, sorry. So we've got, there's 1,700 chamber members. 83% of them are small businesses. What do small businesses need to know about interest rates and the way the Bank of Canada thinks of interest rates in order for them to do some of their longer-term planning?
Well, in terms of interest rates, I think if you compare where we are now relative to when both of us were young in the 1980s, when interest rates were hovering in the double digits, I think interest rates are going to, given that we've done a very good job in terms of controlling inflation, I think interest rates are going to remain relatively low and stable, much lower than they were in the 1980s. And I think that's a consequence of the success of having this inflation targeting framework. So I think in terms of significant swings in interest rates, they're very unlikely to happen given our success in achieving the inflation target. Now, of course, Canadian interest rates are affected by what happens globally, so there's potential shocks there. But I think in terms of what we've done with respect to monetary policy here in Canada, we've done a good job in lowering interest rates, in part by bringing inflation down.
Right. And I would like to say that I was lucky enough to have a 13% mortgage for my first home. It was great. Let's see, what else we got here? Halifax. So we're a relatively little market. I guess I'm kind of curious about how the bank looks at places like a Halifax or a London or a Hamilton or maybe not Hamilton, London, Ontario, or a Winnipeg, when you look at overheated markets, certainly from a housing basis, like a Vancouver or a Toronto, which seem to color the mortgage rules across the country and can have an impact on kind of artificially keeping down the markets like a Halifax. So I guess I'm kind of intrigued in what you think of that.
Well, most of my speech I spoke about hard data like GDP numbers, inflation numbers, things like that. But the bank has a number of regional offices, including one in Halifax, and we do a business outlook survey 4 times a year where we talk to 100 firms across country of different sizes and include a number of small firms in there. And we try to get a sense of what's actually happening on the ground. So we try to look at this, what we describe as softer information, and we definitely put a lot of weight on that in terms of our decisions, because the hard data is useful, but we also need to understand what's happening on the ground, and so we do pay a lot of attention to the soft data. When it comes to housing, we have a national perspective. As at the central bank, we have two primary hats. One is monetary policy, the other one is financial stability. And on the financial stability side, we look at two key vulnerabilities that have arisen. One is elevated household debt that I mentioned, but one is concerns about escalating house prices. And clearly, we saw escalating house prices that weren't sort of consistent with what we thought were fundamentals. And we saw price expectations picking up and prices rising relatively quickly in both Vancouver and Toronto. So that was a concern that we had, and I think the other prudential authorities in Ottawa, in particular the Office of Superintendent of Financial Institutions, the Department of Finance, they were concerned. And so the mortgage rules were in part to address that issue. And I think one of the main things they did was address one of the concerns that we had, that some of the mortgages were creating a very high debt load for Canadian households. Mortgages were being issued at debt-to-income ratios of greater than 450%, which we thought was a vulnerability for the Canadian financial system. And I think what we've seen since the rules have been put in place is that the debt-to-income ratio for the more recent mortgage originations have come down. And I think that's probably likely to have a much larger effect on urban centers like Vancouver and Toronto than they would in some of the smaller areas like London or Halifax. So it's really geared towards the avoidance of high levels of indebtedness.
Okay. What's your opinion on the relationship of cyber currency to the money supply?
Well, cyber currency is, if you're talking about Bitcoin in particular, it's hard to view it as a currency per se because it fluctuates in value so much. I mean, one of the strengths of having low, predictable, and stable inflation is that the Canadian dollar, its purchasing power is going to remain relatively stable, whereas some of the cyber currencies, their purchasing power doesn't remain stable. So whether one can debate whether they're actually a reasonable vehicle of making payments, but they're there for particular purposes. Some of that is to make cross-border payments, which are sometimes easier to do with cyber currencies than otherwise. But I think we already have digital currencies in terms of we all use Visa credit cards, we use other forms of digital payments. They already exist. I mean, at this juncture, we don't see the cyber currencies being really a stable form as a vehicle for payments.
Okay. Should we be worried if there is a downturn in the future as interest rates are already very low? What arrows do you have in your quiver to solve that problem if interest rates are low?
Well, if there was a need to, the Governor Poles gave a speech a couple of years ago on this, and he noted that we can reduce interest rates to perhaps a negative number. I mean, that's an extreme situation, but possibly we could reduce interest rates to minus 50 basis points. So there's room to still reduce interest rates. There's other tools that we can use that fortunately we haven't had to use in Canada, but other jurisdictions have done, such as large asset purchases. And we did use a limited amount of forward guidance in terms of saying that we were willing to keep interest rates low. So I think there are other tools that we can use, and we're working. We have a process of renewing our inflation control agreement every 5 years with the government, and as part of that renewal process, we are reviewing our toolkit and making sure that we have sufficient tools to address the next downturn.
Okay, we're running out of time, but I'm going to ask a couple of quick questions. What are the upside risks, if any, for the Canadian economy with respect to the U.S.-China trade war?
Well, the main upside risk is, I think if there's a resolution of the trade conflict relatively soon, I think that would be beneficial not only for Canada, but for the global economy. There are some, I've read about how lobster shipments from Nova Scotia have increased dramatically because Canadian lobsters being substituted by going to China, being substituted for by instead of lobster going from New England. And so that's a positive. But there are negatives that are rising as well, in the sense that there are canola and exports of pork and beef have also suffered in Canada as a consequence of the trade conflict. So there's some positives and negatives. Fortunately, in Nova Scotia, I think the lobster shipments is a positive story.
It is. Last question. Do you think there is a role for the Bank of Canada to play with the federal and provincial government to ensure optimal economic input, specifically around income and consumption tax? Could there be a higher potential output?
Well, we do analysis of potential output and the factors that do influence potential output. We've spoken about things to improve the competitiveness of the Canadian economy, to improve potential output growth. One is tax rates. Another one is interprovincial trade, which we feel if interprovincial trade were liberalized, that would have a significant impact on potential growth here in Canada. So I think it's important that that governments, as they make their policies, are aware of the impact on potential output growth, and that includes setting a variety of different policies.
That's great. Thank you. Well, we're out of time, so I will end it there. Thank you very much, Deputy Governor Schembri, for speaking to our members today about Canadian and global economic developments. I apologize for not getting through all your